Hey everyone, today I want to talk about something that I hope completely changes how you think about your financial future. The question I want to ask you is: would you rather make $150,000 and keep $100,000, or would you rather make $120,000 and keep $105,000? You see, most people, they chase the bigger numbers, whether it's a higher income, a larger investment returns. But what I've come to learn is that what the wealthy know is what most people miss. It's not really about how much money you earn, it's really about how much money you keep. And I'm not just talking about budgeting and cutting back your lattes. I'm really talking about strategic planning that can put literally tens of thousands, if not hundreds of thousands of dollars extra in your pocket every single year, or even over your investment lifetime or retirement lifetime, just using some income strategies you already have. So I want to share a few ideas there. Hopefully they can help as you're putting your plans together and figuring out these strategies. But the first one is really just what I look at there, people's income illusion. So I want to kind of give you an example here that honestly I see a lot of times. We've got client A, they start making more money, whether it's through a job or raise, or they pull out more money from their investments, and they go from making $100,000 to $130,000. Now a lot of people look at it and say, "Oh, I got $30,000 extra money." They go start living their life, doing their thing. It's exciting. It's a 30% raise. But if they don't do the right planning with that extra money, here's what actually happens. Their marginal tax rate can jump up. They may lose some income tested benefits. They haven't adjusted their investment strategy so they can maximize that. And depending, especially if it comes to retirement, depending on how they're taking that extra 30,000, they're losing different tax strategies and tax benefits. So it's not like uncommon that at the end of the year they're going to be shocked to find that out of that $30,000 raise, they really only kept $15,000 after taxes, because just you got to pay that kind of stuff, and so it's really only a 15% increase versus a 30% increase. Whereas if you look at client B, maybe they go from 100,000 and they go to 120,000, but they work with us to restructure their investments. So we shift high interest investments, potentially into the TFSA. We want to optimize their RSP contributions for their tax bracket, so we're not over contributing to either. We want to convert some income generating investments, maybe use Canada dividend paying stocks in their non-registered accounts, or just implement different RSP withdrawal strategies to lower their income over the years. So the reality is, how we're withdrawing that money, you can maybe again they make less. Instead of 130,000, they make 120,000. But because they're not paying all those extra taxes, they can end the same place or maybe even a little bit better, depending on how we structure it. There's actually something I read about from the Fraser Institute, is that the average Canadian family pays over 40% of their income in total taxes. That's when you factor in income taxes, payroll taxes, sale taxes, property taxes. So what that means is for every dollar you earn, you're really only keeping like 60 cents. And what's important to know is that not all income is taxed the same way. And that's kind of where you can learn things to help take advantage of these. Like, again, this is all legal ways. I'm not saying, hey, let's go do some sketchy stuff. It's really, hey, what's some real ways that we can use to lower the tax burden? So a couple different ways to look at, or some different tax perspectives when it comes to your investment, is the two worst ways that you pay taxes. One is through employment income, because it's taxed at your marginal tax rate. So just having your job, your income, that's one of the worst. And we all have it. And the second, or pretty much everybody has it, but the second one is interest income. And so this is also taxed at your full marginal tax rate. So you're in a 40%, if you're in a 40% tax bracket, if your investments earn 10,000 of interest, you're paying $4,000 in tax. We'll talk about this a bit more in a minute. It's kind of review the different ideas here. So those are the two worst. I want to give you a couple better options that I think can help a lot. One option, in a non-registered account, you can use Canadian dividends. They benefit from the dividend tax credit. So that same $10,000 might only, instead of costing you $4,000 in tax, it might only cost you $2,000 or $2,500 in tax, depending on your province. Another option is through capital gains. So only 50% of your gain is taxable. So you're effectively paying half the tax rate. Another couple great options is using your tax-free savings account for growth. That means when you pull your money out, it's completely tax-free always. There's zero taxes. You don't have to worry about that. 6 is strategic RSP withdrawals. It's not just taking money out as much as you want or whenever you want. You got to put a strategy and a plan in place for this. So the idea is if you contribute to your RRSP at a 40% tax bracket, you withdraw it at, say, a 25% tax bracket in retirement. Well, now you've got that 15% arbitrage. That's essentially profit in that sense. So, another way of looking at it is just that tax planning isn't about evading taxes. It's really about arranging your affairs within a framework of the law to minimize your tax burden. The Income Tax Act allows you and expects you to do this. That was from actually Jamie Golenbeck from he does estate planning with CIBC, and the tax rules are there for us. You just have to kind of know them and take advantage of them. But the truth is, most of Canadians have their investments backwards. They've got GICs and the wrong accounts, and they're getting hammered by taxes, and they're non-registered, and they're not taking advantage of the tax-free growth of RSPs or the tax-free withdrawals or the TFSAs. They're just not utilizing the accounts the way that they can be used. So we got to really look at your account structure. Just structuring your accounts and utilizing your investments strategically.